Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CA Final SFM, we are going to discuss a very important concept, that is capital market and derivatives. In this class, I will begin the discussion with what is a financial market, and the entire hierarchy of financial markets will be understood. Then we will step into the introductory part of derivatives. What are derivatives? How derivative as a contract emerge in the financial markets or derivative market? How does a derivative help parties to participate in terms of minimizing their risk or taking speculative positions? We will also learn the functions and characteristics of a derivative contract. We will also learn how does derivative contract gets settled in the market. We will then discuss about who are the participants in the derivative market, and then we will talk about the types of derivatives: forwards, futures, options, swaps, etc. So let us discuss everything one by one. So getting started with this part, that is concept number 1, financial markets. So friends, what is a financial market and how its entire hierarchy is constructed? Let us discuss that first. A financial market is a market in which people trade financial securities. Securities include stocks and bonds. They also include currencies and other financial instruments, and securities also include derivatives. So that is why derivative market is component of financial market. So let us understand the hierarchy of the financial markets, and here we go. Financial markets are broadly classified into 3 main categories: money market, capital market and forex market. So friends, let us first discuss about these different types of markets, and particularly let us emphasize first of all on what is capital market and money market. The difference between the money market and capital market over here. Now see, financial market is a market where people trade in financial securities. Now financial securities could be small short term instruments like even bill of exchange. It could be a long term securities like bonds and shares. So when we are dealing with short term securities, for short term securities it is money market, and for all long term securities, the part of the financial market where long term securities like bonds and shares are dealt with, that is the capital market. Now the last category over there, that is forex market, is not the point of discussion right now. When we step into forex market and foreign exchange risk management, we will learn everything about forex markets. As of now, let us restrict our discussion to money market and capital market only. So I have first of all told you that money market is the market for short term securities, capital market is a market for long term securities. So what will happen? Within capital market you will find 2 different components, that is the stock market and bond market. You can call it bond market or you can even call it as a debt market. So the primary classification of the capital market will be into stock market and debt market. Each of these components of stock and debt market are further classified into primary market and secondary market. It is very important for you to understand what is a primary market and what is a secondary market. So first of all, what is a primary market? Primary market is a market in which the issuing company will come up with the issue of bonds, debentures, shares or whatever kind of debt instrument or securities it is coming up with. So primary market is the market where the issuing company is coming up with an issue of the security, and the investors on the other side will be participating by making a subscription to such securities. Now if you could see, the actual fundraising activity from the viewpoint of issuing company happens in the primary market. So suppose a company is coming up with an IPO, it will be a transaction in the primary market. So when the security is once floated in the capital market, thereafter the investors among themselves will continuously trade in those securities by purchasing and selling shares, by purchasing and selling bonds and debentures. The trading of these securities among the investor, the continuous buying and selling activity among the investors is a component of secondary market. So you should be very clear about what is a primary market and what is a secondary market. For your reference, once again I repeat, when an issuing company, suppose a company is coming up with an IPO, the company issuing shares under an IPO will be a transaction in primary market. Once those shares have been subscribed for, issued and allotted, the primary market function is done. Thereafter, the company is not going to have any fundraising activity with respect to that share issue. What will happen? The investors in the stock market will trade in those shares, continuous on daily basis, buying and selling of those stocks, dealing with the derivative instruments based on those stocks. That will be part of the secondary market. So friends, what I have just told you, focus on capital market, which is classified into stock market and debt market. Each of these components are further classified into primary market and secondary market. Now, when you focus on the secondary market component of the stock market, you would find the secondary market itself is further classified into cash market or spot market and derivative market. So spot market and derivative market are the further two components of the secondary market. So friends, when we are making up this entire hierarchy structure, I want your complete attention over here on the screen, and for your reference what I'll do is I'll just expand the screen size so that you can note down everything clearly. As I have just mentioned, capital market classified into debt market and stock market, and now stock market classified into two components, primary market and secondary market. For that reason, even money market and debt market are classified into each of these segments, that is primary market and secondary market. My friends, our focus right now is on the stock market. So let us focus on stock market only. So the secondary market part of the stock market is further classified into spot market and derivative market. Spot market also known as cash market, and derivative market also known as FNO market. FNO stands for futures and options. So basically derivative market has two components, futures and options, and each of these are classified into further three categories. These are stock futures, index futures and currency futures. Likewise, options are also classified into same three types, that is stock options, index options and currency options. Alright friends, let us move ahead and discuss meaning of derivative. So let us first discuss about what exactly is a derivative. A derivative is a contract between two parties. It is simply a contract between two parties expected to be settled at a future date. I repeat, it is a contract between two parties expected to be settled at a future date. So it is basically a contract whereby two parties would agree to negotiate, two parties would agree to buy or sell something at a future date at a price which is agreed today. That is an important characteristic of derivative contract. So it is simply when I enter into a contract with you and we agree that one of us will buy, another party will sell something at a future date at a price which is agreed today, then the contract between the two parties is simply a derivative contract. So if you have to define what is a derivative, it is a contract between two parties expected to be settled at a future date. And now coming to the most important point is, it derives its value from the changes in the price of the underlying asset. That means the word derivative has formed from the characteristic of this instrument because it derives its own value from the value of the underlying. So here you might have a doubt as in what is this underlying. Suppose you and me, we enter into a contract to trade in shares of Tata Motors. So suppose I have agreed to sell shares of Tata Motors to you, and you have agreed to buy those shares from me at a price which is already fixed, and the date on which this settlement will take place is also decided, everything decided, price, date, everything decided. Now that what will happen, one of the parties will be making gain, another party will be making a loss. For example, if the agreed price of the share is 500 and if the actual market price at the settlement date is different from 500, one party will be making a gain, another party will be making a loss. As a result, it is obvious that the gain or loss is arising to the two parties exactly because of the movement of the price of shares of Tata Motors. As a result, the shares of Tata Motors for that contract will become an underlying asset or simply an underlying. So friends, one of the important characteristic of a derivative is that it derives its value from the value of the underlying. So if you want to once again focus on the definition of the term derivative, we would say a derivative is a contract between two parties expected to be settled at a future date, and it derives its value from the value of its underlying. Now, what could be underlying? Underlying asset could be anything. It can be shares, it can be foreign exchange, it can be another instrument, it can be a commodity, it can be interest rate, it can be an index, it can be anything. Anything can be an underlying depending on the fact that what you are entering into the contract for. It is the subject matter of the contract. Suppose I am entering into a forward contract for purchasing food grains, then the food grains become the underlying asset. So I am entering into a contract to buy metals, the metal will become the underlying asset. If I am entering into a contract to purchase or sell gold, gold becomes the underlying asset. Whatever be the subject matter of the contract, that is what we call as underlying. And because of the price fluctuation of the underlying asset, the price of the underlying asset as and when it changes, the value of this derivative contract will change accordingly. For having much clear understanding about this, we have to deal with lots of examples in front of us. So as and when we proceed ahead, I will introduce lots of examples and your attention should be on screen so that you can write up everything systematically, so that you can observe everything in clear way. I am expanding the size of the screen. Please take note of everything that you are shown over here. As I have just mentioned, a derivative is a contract between two parties expected to be settled at a future date. Its value is derived from the value of the underlying assets, and no initial investment or very small amount of initial investment is required. So my friends, I am giving you time. Please take note of this. These four important components of the definition of derivative should always be in your mind. Let me now take you ahead with that example what we have just discussed. You want to acquire 500 equity shares in NJ Limited. Each equity share is presently quoted at rupees 1000. You enter into a contract under which after 3 months you can buy 500 equity shares in NJ Limited at rupees 1000 each. The contract gives you the right to buy 500 equity shares. So what is happening in this example? You as an investor, you declare that you are interested in buying shares in NJ Limited, and you also declare that you don't want to buy it now. You want to buy these shares after 3 months, and NJ Limited offers you right to buy 500 shares at rupees 1000 each after 3 months and through a contract signed and delivered. Now this is a derivative. This is a derivative because it fulfills the conditions of derivative what we have just understood. It offers you an option to buy the shares at rupees 1000. Not to forget the fact that presently these shares are traded in the market at rupees 1000. So if presently the shares of NJ Limited are priced at rupees 1000 in the open market, this contract is worthless. However, if after 3 months the price of these shares turn to be rupees 1250 per share, Now I have explained you this matter already. Something which is traded in the market at rupees 1250 and you have a right to buy these shares at just 1000, this contract will attain some value. The worth of this contract will be difference between 1250 and 1000 multiplied by 500 shares, which works out to rupees 1,25,000. So the contract has derived this value from the price movement of the underlying asset, that is shares in NJ Limited. What happens if the price of the shares goes to rupees 950 after 3 months? It will be better to buy these shares from open market rather than exercising this right or using this option contract. As a result, this contract again becomes worthless. So one concluding point is that this is a derivative because it derives its value from the movement in the price of the shares. And now let us understand some important conclusions that can be drawn from this example. Number one, the contract is a derivative instrument because it fulfills all the conditions of a derivative. It gives you right to buy the shares. The underlying asset is the equity shares in NJ Limited. The value of the contract changes with the changes in the price of the equity shares. It derives its value from the value of the equity shares. My dear friends, you need not write up all this because in your textbooks these points have been mentioned exactly the same way. So let me now take you to another very important point. While in the example given above the underlying asset was equity shares, in the derivative market underlying asset could be commodities, precious metals, foreign exchange rates and interest rate relating to financial assets and even market indices. Alright, let us move ahead and talk about functions of derivatives. One very important function that derivatives are expected to perform. Financial derivatives help in facing financial risk arising due to changes in prices, interest rates and currency rates, and such instruments provide a commitment to prices for a future date, thereby protect a party against future adverse movements. So the third point over here would be financial derivatives also provide opportunities to make profit for those who are ready to bear risk. And finally, in the process, derivative transfer the risk from those who want to avoid it to those who are ready to take the risk. So my friends, I am giving you time, please take note of this. Let us now talk about characteristics of derivatives. The first very important characteristic what we find is the transactions in the derivatives are settled by the squaring of such transactions in the same underlying. The difference in value of the derivative is settled in cash. There is no limit on the number of units transacted in the derivative market because there is no physical asset to be transacted. And then the next, derivatives are only secondary market securities and cannot help in raising funds to a firm. In fact, derivatives arise only when the shares and debentures are already issued by the companies. So my friends, I am giving you time, please take note of this. So friends, let me discuss all these points elaborately over here for your clear understanding. So if you can see these characteristics of derivatives, first of all, when you enter into a derivative contract in the derivative market, so what will happen is you would see that there will be a settlement in a particular way. Each derivative contract is settled in a particular way. So later on we will talk about one additional aspect, that when two parties are entering into a derivative contract, it could be an contract of the type OTC, that is over the counter type. Over the counter means two parties sitting across the counter and entering into contract. These contracts are not through the exchange, they are directly done without the purview or without the involvement of the exchange. That is one thing. And another contract will be exchange regulated, where the contract is initiated and settled via exchange. If a contract is initiated and is settled through the exchange, through the derivative market, then one thing is definite, that there won't be settlement by actual delivery. Settlement will be with respect to the price differential in cash. How exactly it would work, we will learn that ahead also through some examples. But that is one important characteristic, that settlement will be done through the price differences in cash. If you want, I can give you just a short example. Suppose I have agreed to buy shares from you, that is shares of X Limited, and the agreed price is 500. Okay, I am supposed to buy those shares, you are supposed to sell those shares. Agreed price is 500. At the settlement date, the market price of the share is 520. So we would say a share whose market price is 520, I have agreed to buy at just 500 and you are committed to sell at 500. So I have made a gain of rupees 20, you have incurred a loss of rupees 20. So it will not happen this way, that you buy the share at 520 and then sell it to me. What you will do is, you will directly pay me that differential. That could be a typical objective of these two parties, myself and you, entering into a derivative contract that let the settlement happen in cash. So no actual purchase sale would happen. That is an important characteristic of derivative. In derivative market, all the derivatives are settled in this manner. Now, what happens if someone wants the actual delivery? There are two ways. Number one, you can make a derivative contract which is over the counter type, means exchange is not involved, or if exchange is involved, you make a derivative contract, get that price difference in the cash settlement mode, and finally if you want to buy or sell, that buying and selling activity will actually happen in the spot market. So friends, basically in a nutshell, I would say the derivative market functions this way, that you don't have to actually make purchase and sale. The settlement is just made on the price differences. Now, when we move ahead with speculative derivative contracts, I will bring those examples in front of you. What is the role of margin money? What is the mode of settlement via margin accounts? We will discuss everything. Let the right time come. Right now, let me focus on the second characteristic over here. As the first characteristic we have learnt, that over here there will be settlement in cash. When no actual buying and selling is going to happen, there is no limit to the number of derivative contracts you would want to enter into. Suppose a company has total share capital as 1 lakh shares, but you can enter into a derivative contract of dealing with even 2 lakh shares. That means more than the share capital of the company, you are finding derivative instruments being traded on that. It is possible. It is definitely possible, because you don't have to actually purchase and sell these instruments. It is just a settlement on a cash basis. No limit to the number of contracts that you would want to execute. And lastly, derivative market itself is classified under secondary market. So through the derivative market, a company cannot raise funds. So derivative market and derivative instruments cannot be used by a company for fundraising. This is again an important characteristic that you should understand. Now, before these characteristics, what we have seen is the functions of derivatives. So if you can recall, one of the function of derivative is to provide the hedging of price risk. Now let me give you one simple example. There is a typical type of derivative classified as a forward contract. Let me give you an example of such a derivative via forex market. Suppose I am importer of goods. I have imported goods worth $10,000 and the payment of that invoice has to be settled after 2 months. So I know one thing, that after 2 months I have to remit $10,000 to another party in US. Now what will happen? After 2 months, the price of US dollar is uncertain today. After 2 months, the price may rise further, price may drop, price may be stagnant. Fine. I would want to secure my position. So I approach a bank and enter into a forward contract with bank that I will buy 10,000 US dollars after 2 months at a price of rupees 70 per dollar. Myself and bank, we both agree. That means on that date after 2 months, irrespective of the price of the US dollar prevailing in the spot market, I will be entitled to buy US dollars at a definite price which is contracted already. As a result, the price fluctuation in the forex market with respect to dollar against Indian rupee will not affect me because my transaction is secured. That is how, by entering into a forward contract or by entering into a derivative contract, someone can safeguard their financial risks. So one important feature of the derivative is to provide safety, is to provide hedging opportunity to someone who would want to avoid risk. On the other side, derivatives also provide opportunities of earning profits for someone who is ready to take risk. That means we are talking about people like speculators, someone who would want to speculate in the derivative market and make profit out of that. But remember one thing, making profit out of that through a transaction which is a speculative transaction would involve high degree of risk. So understand one thing, someone might incur some extra cost and protect themselves from financial risks. These parties are called hedgers. Someone might want to take risk and make money. These are speculators. Whereas there could be even another set of parties who actually don't want to take any risk but still want to make profits. Even for them, there is an opportunity. Making riskless profit is what we call as arbitrage. So friends, objective of entering into derivative market could be speculation, could be hedging of financial risk, could be arbitrage, any kind of objectives. So who will be participant in the derivative market? It could be hedger, it could be a speculator, it could be an arbitrager. So if you are entering into a derivative market, if you are entering into a derivative contract with hedging as your objective, with minimization of risk as your objective, you will be known as a hedger. And what you are doing is performing a hedging technique. If you are entering into a derivative contract with a speculative motive, with a motive to make money out of derivative market, that means you are taking risk for making money. So if you are taking risk for making money, you are a speculator. If you are trying to avoid the risk, minimize the risk, manage your risk by even incurring some extra cost, your characteristic is of a hedger. So hedgers, speculators and arbitrators are different types of parties who are involved in derivative market. Now friends, it is important for you to understand that what are different types of derivatives. Over here, I would say that there are generally 4 types of derivative instruments, what we call as forwards, futures, options and swaps. So we have 4 types of derivative instruments. We have 3 types of participants in the derivative market. So you know, making all possible permutation combinations, you would see that there will be multiple scenarios that can be created in derivative market for different type of derivative contracts. So this is therefore going to be a big chapter to discuss about, and that is why each segment of this chapter I have separately covered in each of the upcoming videos. So let us do one thing, let us write some additional notes about what we have just discussed. Let us now talk about types of derivatives. 4 types of derivatives have been in existence: forwards, futures, options and swaps. Friends, as and when we proceed ahead in the chapter, we shall discuss each one of these components in details. So let us also talk about participants in derivative market. Generally, the participants may be classified into 3 types. Number 1, hedgers. Number 2, speculators. And number 3, arbitrators. So we have already discussed who are hedgers and who are speculators. What is something different for you is this arbitrager. But yes, we have learned a bit of arbitrage and concepts relating to arbitrage in Forex chapter already. Anyway, who are hedgers? Hedgers are parties who avoid risk by incurring cost. Speculators are parties who make profit by taking risk, and arbitrators, they are parties who make profit without taking any risk. Going ahead, we talk about the first component of derivatives, that is forwards and futures. So what is a forward contract? A forward contract, we have already discussed about this. It is a contract for buying or selling a security at a specified date in future. But one very important characteristic of this forward contract would be the price has to be agreed today. That means what is defined as a forward rate. Forward rate is a rate which is agreed today but applicable for buying or selling securities at a specified future date. And when you enter into a contract using such forward rate as a committed rate, such contract becomes a forward contract. So let us take this by an example. Mr. A, he says, I want to buy 500 shares of X Limited at rupees 560 each after 3 months. Mr. B says, I agree to sell 500 shares of X Limited at rupees 560 after 3 months. So these parties, one is behaving like a buyer, another is behaving like a seller, and finally they say, let us make a deal, let us sign a contract. And they have agreed and signed a contract. Now what happens? This contract itself is again titled as derivative because again it is fulfilling all the characteristics, all the conditions given in the definition of the derivative. So if after 3 months the price of the share of X Limited turns to be rupees 550, what will happen? Mr. A loses rupees 5,000 and Mr. B gains rupees 5,000. Why? Because B has agreed to sell at 560, A has agreed to buy at 560, but the prevailing market price on the settlement date is rupees 550. As a result, A has made a loss and B has made a profit, and that differential of 560 and 550 multiplied by contract size of 500 shares, the total amount of gain or loss for the two parties is coming up as 5,000 rupees. Now what happens if the price goes the other way? If after 3 months price of shares of X Limited turns to be rupees 570, then what happens is Mr. A gains rupees 5,000 and Mr. B loses rupees 5,000. This time this 5,000 has been computed as a difference between 570 and 560 multiplied by 500 shares. So this is a derivative contract because it is deriving its value from the movement in the price of the share, and this is a forward contract. Earlier we have taken an example of option contract where the party has simply a right to perform, right to buy or sell. Here in this case, both the parties have right as well as obligation. That is a very important characteristic of a forward contract. Let us move ahead and talk about speculation through derivatives. Before we talk about speculation through derivatives, it is very important for anyone to understand what we mean by bullish sentiments. Bullish sentiments are simply expectation of parties, expectation that the price will rise in future. So this is all about what you have as an expectation towards the future price. If a party has expectation that the price will rise in future, we simply say that the party has bullish sentiment, and bearish sentiment on the other side indicates expectation that the price will fall. We extend the same example in a speculative scenario so that we understand speculation through derivatives. So let us go ahead. So we again find Mr. A. Mr. A says X Limited's share quoted rupees 560 now. After 3 months, price will rise. That means we can conclude that Mr. A has bullish sentiments. Mr. B says no chance. After 3 months, the price will fall. That means Mr. B has bearish sentiments. Obviously, both the parties cannot be correct. One of the sentiments will be correct, another will go wrong. Now, Mr. A further says, I agree to buy 500 shares of X Limited at rupees 560 each after 3 months. Because Mr. A believes that the price is going to further rise, he is ready to buy at the current price after 3 months. On the other side, obviously Mr. B would agree to sell these shares at 560 after 3 months, because Mr. B believes that the price is going to fall from this level. So Mr. A proposes, let us make a speculative deal, let us sign a contract, and B says we shall square up the price difference in cash. So they sign up a contract and the deal is done. Now what happens afterwards is to be understood. Now this is again a derivative. If after 3 months the price of shares of X Limited turns to be rupees 550, Mr. A loses rupees 5000 and Mr. B gains rupees 5000. Now why 5000? It is because difference of 560 and 550 multiplied by 500 shares would give you a total amount of gain to Mr. B of rupees 5000 and loss to Mr. A of the same amount. So what should happen? Because this is derivative, it has to be settled by way of price differential in cash. What Mr. A should do? Mr. A should simply pay rupees 5000 to Mr. B. So here comes the claim made by Mr. B. He says, come on, clear of your due, simply pay rupees 5000. So what is unexpected happening over here? Mr. A denies. He says, do you really think so? Forget it. Now here, in spite of Mr. B making a profit, Mr. A is daring to make a default, and default in the contract, Mr. B simply cannot do anything. A better way to deal with defaults like this, before signing up the contract, both of these parties should have involved an intermediary. So assume that Mr. NJ has been called upon as an intermediary, and this intermediary says, wait, before you sign the contract, both of you deposit with me rupees 20,000 each. Now both of yours deposits are with me. So Mr. A's balance is rupees 20,000, Mr. B's balance is also rupees 20,000. So what happens after 3 months of signing the contract? We have seen Mr. A has lost rupees 5,000 and Mr. B has made a profit of rupees 5,000, and how we have calculated this 5,000 we have already discussed earlier. So Mr. A should pay rupees 5,000 to Mr. B. Now this settlement will be much more simplified in this case. What intermediary will do is simply deduct rupees 5,000 from Mr. A's balance, making it just 15,000, and will simply add that 5,000 to Mr. B's balance, making it 25,000. So once the settlement is done, Mr. A will not get back rupees 20,000 but would receive only rupees 15,000, and Mr. B on the other side would receive a total amount of rupees 25,000, which is inclusive of the profit element made in this contract. So the basic question that now would arise is, who would become this kind of intermediary for these two people? Okay, so you don't have to go and hunt for this intermediary. The derivative market itself functions as an intermediary. So if you could see, friends, without the involvement of intermediary, when A and B just entered into a contract themselves, it was over the counter. When they want an involvement of intermediary, they would both approach derivative market and make a contract. In such case, it will not be just a forward contract, it will be then classified as a futures contract. So here we should understand one thing very clearly, that there is just an upgradation of a forward contract where there is standardization. So there will be a definite contract which is available in the derivative market as a forward contract, though it is not called a forward contract. But first of all, you try to understand there is a definite forward contract. You can buy or sell a particular share at a certain specified date, at a certain specified price, and a certain specified quantity. So quantity, price, date of settlement, everything is standardized. You just have to go and decide whether at that price you want to be a buyer or you want to be a seller. That all is required. So you would find that such a forward contract, which is a standardized version, and which has an intermediary involved in the form of derivative market, it is no more called a forward contract, but it becomes a future contract. So futures contract in derivative market is just an upgraded version of forward contract, taking all the benefits of forward contract but not getting involved into any kind of limitations or drawbacks of the forward contract. So the biggest drawback of forward contract, what we have seen earlier in the example, that was parties may make a default. In derivative market, if it is a futures contract, there is no chance of default, because derivative market will take the guarantee of performance. If one party is not performing, that is not the problem of that other party. The other party's rights will be taken care of. Whoever doesn't perform, they will be at the losing end. So friends, once we move ahead in the chapter, your clarity will be more and more when we start dealing with examples after examples. So let us do one thing now. Let us first of all focus on the differences between forward contracts and futures contracts. So keep paying attention over here while I expand the screen size for you to have better understanding of all these concepts what are appearing over here. You may write everything systematically one by one. So what we can conclude is, for a variety of reasons, future contracts stand superior to forward contracts. So let us also discuss the meaning of futures contract. A future contract is a standardized contract between two parties where one of the parties commits to sell and the other commits to buy a specified quantity of a specified asset at an agreed price on a given date in the future. My friends, what you need to do now is to understand the complete meaning of futures contract and also to understand how futures contract differ from forward contracts. So let us look at the main features of a futures contract. Three main features. Number one, the contract is standardized with respect to quantity, date and price. The next feature, the clearinghouse has a key role to play in trading of futures contract because it guarantees the performance. And the third point is, the exchange or derivative market would require the parties to maintain a deposit, there is a margin with it. The margin amounts changes with the changes in the daily prices. In effect, the profits and losses are settled on a day-to-day basis. A futures contract simply upgrades a forward contract into a secured, riskless, marketable instrument. Let us now talk about important differences between forwards and futures. So the first thing what we have already discussed, forward contracts are OTC type, that is over the counter type, whereas futures contracts are exchange regulated. Futures contracts are standardized with respect to price, quantity and date of settlement. Forward contracts can be customized contracts as required by the parties to the contract. Now the third point is, futures contracts are marketable instruments, forward contracts are not. So let us go ahead and talk about the fourth point. Forward contracts are unique because only those parties should settle the contract who have originally entered into the contract. On the other hand, futures contract provide flexibility of making entry or exit even before maturity. Due to this flexibility, the parties to the contract keep changing. So you would see this fourth point is directly connected to the third point that we have discussed with respect to the marketability of these futures contract. That is, futures contracts are marketable instruments. Next, forward contracts have risk of default as the performance is not guaranteed, whereas in futures contract there is guarantee of performance as the exchange itself regulates the futures contract. Alright, moving ahead, the next point of difference, forward contracts may or may not require initial margins to be deposited, whereas depositing initial margin is a prerequisite in any futures contract. Next point, forward contracts may provide for actual buying or selling, that is actual delivery, whereas futures contracts are settled in cash by receiving or paying the differentials in price necessarily. Alright friends, moving ahead, we talk about the next concept, a very important concept, that is about long and short positions. So let us begin discussion about what exactly is a long and short position. Now friends, in the stock market and in the futures market, these concepts will have a little bit of altered meaning, though it is one and the same, but still a student should be able to differentiate between the two. Right now what I am talking is about long position and short position in the stock market. That means I am not talking about derivative market, not about futures market, about the spot market within the secondary market. So what do we mean by long position? A long position simply means taking a position of buying a stock now and holding it, waiting for the price to rise and then sell it in the future. That means if you have bullish sentiments and if you are expecting that the price would rise, what you would obviously do is you would buy the stock now, hold it, let the price rise and then sell it in the future. This whole action plan done today of buying the stock and holding it is what we call as taking a long position. Inversely, imagine that you have bearish sentiments about a stock where you expect that the price of the stock would fall in the future. What you would obviously want to do it, sell now and buy it later on. But to sell the stock, you should have the stock. If you have a stock and you sell it, it's done. But if you don't have a stock and you want to sell now, how will you do it? Here comes concept of short selling. So the short position in the stock market is generally assisted with another concept that we are going to learn ahead, that is short selling. What is short selling? Simply, you don't have something and you want to sell it now. How will you do it? You borrow something, sell it, wait for the price to get reduced, then buy it back and give it back to the person from whom you have borrowed. Let me give you an example. Just imagine that share price of X Limited today is rupees 500. I expect that the price would fall down to 400 within a month's time. So I would want to sell the stock now and maybe buy later on. But I don't have that stock. Nothing to worry. In the stock market, this can be assisted by a function called short selling. Now what is this short selling? Try to understand. Short selling is a concept where I can go and borrow the stock. So you should understand, borrowing and lending of stock in India started in the year 1997 when SEBI announced its stock lending scheme. Today also it is popularly known as stock lending scheme of SEBI, introduced in the year 1997. So right from then there is a system of stock lending. So what will happen is, suppose somebody who is holding stock of X Limited and does not want to sell, I can go and borrow that stock. The counterparty will lend the stock. I have borrowed the stock. The borrowed stock I would sell now. I have an obligation to give back that stock after a month's time. So if I have borrowed, I have to borrow for a definite period. Here theoretically I am assuming that the period of borrowing is 1 month. So for 1 month, if I have borrowed the stock, the borrowed stock I will sell today. I will get the money. I will just wait for the price to fall. Once the price falls, I will buy back the stock at a low price. The price differential already has been earned by me as my gain, and I would give back the stock from whomsoever I have borrowed. And of course, someone will not lend the stock freely, correct? So that party, the counterparty, will make some charges, typically known as stock lending charges. I would give back the stock along with stock lending charges, matter over. So friends, basically what we are trying to conclude is there will be process of stock lending and stock borrowing, which will be assisted when we are talking about short position in the stock market. So to summarize this whole discussion, I would say long position means a position of buying a stock now and intending to sell it at a later stage when the price rises. Question is, who will take long position? Someone with a bullish sentiment will take a long position. What is short position? It is a position of selling the stock now and buying it later when the price actually falls. So you sell at a high price, you buy at a low price. This could be primarily assisted with the function of short selling. I have also explained you what is short selling. So short position is selling now with an intent to buy later. So friends, what I would want you to do is, you should carefully note down these concepts and the follow-up examples and discussion what I have in for you. So you just keep paying attention on the screen. What I will do for your reference is expand the screen size so that you can write up all the notes properly. As we have just discussed, long position is a position that indicates buying now with the intent to sell later at a higher price. Obviously, this position will be taken when the trader has bullish sentiment. Short position is a position that indicates selling now with the intent to buy later at a lower price. Obviously, short position is planned by a trader who has bearish sentiment. So my friends, I am giving you time, please take note of this. So let us try to understand this better. Long position, as I have just explained, imagine that this is the expected price movement. That means this is not a trend in the past, this is the expected price movement. Now concentrate on this. Assume that this point over here is the current price and we are expecting that the price would move, and we would want to take entry over here and we would exit the trade at this particular point. So what we do is we make entry at a lower price. When we make entry at a lower price and plan to make an exit at a higher price, we consider this exit as our target. So obviously, what you would do for making an entry and what would you do for making an exit? Obviously, you would buy at this entry and you would sell at the target. This is clearly what is understood as long position. Let us also try to understand the short position. So short position, as we have discussed, a position that indicates selling now with intent to buy later at a lower price. So again, imagine that this is the expected price movement, right? This is the current price point and this is the price what we are expecting to prevail in future. So current price is placed over here at which we are trying to make an entry, and this is the point where we are trying to plan our target. Obviously, no one would want to buy at a high price and sell at a lower price. That means to make benefit, you should sell at a high price and buy at a low price. So if you have the stock, sell it now and buy it again later. If you don't have the stock, then short selling has to be accompanied over here. That means instead of simply saying sell, I would say sell short, or short selling happens over here at the entry, and then when you have to buy, you just simply don't call it as a buy, rather you call it as buy to cover. Buy to cover necessarily indicates a position to cover your short selling position that you have made earlier. So this draws our attention to discuss the next concept, that is short selling. Short selling involves selling a stock which you don't own and buying it back later to square the position. A short seller resorts to this strategy because he expects price to fall and wants to benefit from the fall. In falling market, this is a good way to make money. So my friends, I am giving you time, please take note of this. But let us also discuss in detail how short selling works. The term short selling refers to selling a stock that is not owned when the stock price is at high in the market and is expected to decline in future. One can make gains by short selling. This is done by borrowing the stock from someone who holds such stock, thereafter selling the borrowed stock and waiting for the prices to fall. Once the stock price falls, repurchase, that is buy to cover the same stock at such low price and return the borrowed stock to the stock lender along with the stock lending charges, whatever applicable. So my friends, I am giving you time, please take note of this. Now let us discuss the connecting concept, that is long and short positions in futures contract. Long and short positions in futures contract would mean a long position would be a position that indicates buying at the contracted price, and short position is a position that indicates selling at the contracted price. So my friends, I am giving you time, please take note of this. Let us understand this with examples. You hold 100 shares of X Limited currently priced at rupees 440 each. A 3-month futures contract is priced at rupees 452 each with a lot size of 100 shares. The margin to be deposited in the futures contract is rupees 4,000. Explain how you can sell the shares at rupees 452 after 3 months. So as an answer to this question, you can simply say, as you want to sell the shares in future, that is after 3 months, you should enter into a futures contract of 100 shares with a short position at a contract price of rupees 452 per share and deposit margin of rupees 4,000 and wait for 3 months. My friends, this is something which is not given in your textbook, and I would want you to write. Alright, moving ahead, you may write further. Assume that after 3 months the price of the share in the spot market is rupees 430. You can still encash rupees 452 on selling such shares. How will you do that? Let us try to understand. You will have to sell the share at a price of rupees 430 in the spot market. On the other side, you will make a gain in the futures contract, that is 452 is the contracted price at which you have taken the short position and 430 is the price prevailing on the settlement. So your gain will be rupees 22 per share. Accordingly, rupees 22 multiplied by 100, rupees 2,200 of gain will be added to the margin balance. So realization will be 100 shares into 430, that is rupees 43,000 you will realize in the spot market, and the profit from the futures contract will be 2,200. So ultimate realization in your hand will be rupees 45,200, which simply indicates a realization of rupees 452 per share, even though the spot market price was rupees 430 per share. So my friends, I am giving you time, please take note of this. Alright friends, let us move ahead and deal with another extreme possibility. What if the share price would have risen up? So consider that after 3 months the price of the share in the spot market is 470. Though the price is 470, you will not be able to encash 470. You will still encash rupees 452 on selling such shares. How? You will have to sell the share at the price of 470 in the spot market, and what happens on the other side, you will incur a loss in futures contract because you have agreed to sell at 452 and the prevailing price on settlement is rupees 470. You incur a loss of rupees 18 per share. Now what will happen? 18 multiplied by 100, that is rupees 1,800 of loss will be reduced from your margin balance, and realization what comes in your hand will be 47,000 you will realize from the spot market by selling your shares in the stock market, and loss incurred in the futures contract will be reduced out of this realization. So net realization in your hand will still be rupees 45,200, even though the share price has risen to 470. So friends, please take note of this whole thing and then we move ahead. Alright friends, you would have finished writing this whole thing. So what we have discussed in this whole session, if I can just summarize, we have discussed the hierarchy of financial markets, then we have discussed what is derivative, what are functions of derivative, what are characteristics of derivatives, what are different types of derivatives, who are participants in the derivative market. We have then learned about forward contracts and futures contracts. We have taken examples of understanding how a speculative forwards and future contract would function or would take place in a derivative market. So friends, this is a big chapter. There are lots and lots of concepts attached to this. So this was just the introductory lecture which we have classified as part 1. Later on, we will have a long discussion about each and every component of derivative in details. So what you just do is stay tuned to these videos, stay tuned to this channel and make sure that you are getting all the concepts in the proper link. And my suggestion is follow each part separately, part 1, part 2, part 3, part 4 and so on. So we will be having more than 12 parts for this derivative topic and this can be declared as end of part 1. So thank you so much for attending this class.